Good morning. You're listening to FloorDaily.net, and I'm Kemp Harr. This morning, my guest is Robert Murray, the chief economist with Dodge Data and Analytics. Bob, how you doing?
I'm doing just fine.
It's good to be with you. So every year in October, you write the Dodge Construction Outlook, and you've published the 2018 version, and so I thought our listeners would like to hear about it. It looks like in 2017, construction starts were up 4%. And for 2018, you're calling for a growth of 3%. So things are tapering off just a little bit, aren't they?
Yeah, I think the story is that we're looking at a maturing construction expansion. I know there's been some concern that perhaps this expansion has been a bit long in the tooth, and particularly when you look at the commercial building sector, there's concern that maybe we're on the verge of a downturn. That being said, when you look at the various factors that affect the major sectors, it is true that growth is slowing, but we're still expecting growth to take place in 2018. Now, this is different, of course, than the double-digit expansion that we were seeing during the 2012 through 2015 period, when overall construction starts were growing in the range of 11 to 13% per year. But that being said, having moderate growth this year at 4% and an estimated 3% gain in 2018, I think is still a positive story.
Okay. I'm looking at a few of the details here, and there's actually a table on page 2 that takes you through so that you can see everything all at once. And our audience is focused on anything that's got floors in it. So,
right.
When you start talking about electric utilities and gas plants, they're going to be down next year 13%. That's not going to affect our business at all, which is good because that's a factor in your overall growth. So when you say 18's growth is going to be 3%, and that's down 13, that means that some of that negative impact is not going to affect our business. Total, you say, again, is up 3. One of the neat things in looking at this is that single-family housing, you're predicting, will be up 9%, and multifamily housing will be down 8%. Talk about that if you would.
Well, single-family housing has had a very subdued recovery to date, and we are expecting some demographic benefit from the millennials, the older millennials that are moving into their 30s. I mean, you just can't stay living, in an apartment or living with your parents indefinitely. And we have seen at least anecdotal evidence that the demand for single-family housing is beginning to pick up among that particular age group, meaning the older millennials. By the same token, I think with multifamily housing, it's a bit different story in that multifamily housing was really leading the residential recovery all the way through 2016. More recently, though, there is signs that multifamily housing is beginning to settle back, but it is still, I'd say, functioning at a fairly high level. I think the important thing to keep in mind is that single-family housing, at least in terms of units, has not yet reached the halfway level of its peak back in 2005.
Right.
By the same token, multifamily housing has virtually matched the peak level that it experienced in the prior decade. Mm-hmm. So even though growth is subsiding for multifamily housing, it is coming from a high level, whereas the pickup that we're looking at single-family housing is coming from a relatively, I'd say, modest recovery to date.
This is good news for the flooring business people that are listening because single-family housing is a larger square foot area, and there's more flooring that goes into single than goes into multi. So this is good news indeed. And I might add that for your outlook in billions of dollars is right at that 765 number, and your revenue number for single family is 240. So that's a big part of what you're calling for next year.
Well, single-family housing will shape the overall construction market. By the same token, I think, to some extent, there are some vulnerabilities for single-family housing in that one can expect demographic demand to materialize, but it might take longer than what someone might first think. I think, when you look at overall single-family growth, mortgage rates are still relatively low. Certainly we're dealing with a situation where there's not a lot of excess inventory. But that being said, the projection of a 9% increase in dollar amount, which translates into a 7% increase in units. It's something that I would say is, the factors weigh in that direction, but there still is some uncertainty with regard to whether or not single-family housing will be able to show that increase, or whether perhaps it'll plateau at pretty much the level that was established in 2017.
Yeah, I'll tell you, another hurdle in that area is skilled labor. Builders are having trouble finding people that can do the trade work that's required.
Yeah, I think, the labor issue certainly has been brought up, and I think in particularly hot markets, it is a constraint that will limit the extent of the expansion. That being said, we've also been seeing a pickup in wage rates, which is kind of economics functioning as it should, meaning if you're dealing with a shortage of labor, then essentially the price of that labor does go up and it attracts more people into the field. I guess the caveat there is that sometimes it takes a bit of time in order to get those workers actually available at the construction site. So yes, that is a constraint.
All right, let's dig in this area you call commercial buildings. In commercial buildings, you're calling for a 2% growth in dollars. Obviously, there's 5 or 6 vertical sectors there. Where do you think the strength's going to be? Is it going to be in corporate or education? What are you calling for?
Well, for commercial buildings, we're really talking about these project types. We're talking about office buildings. We're talking about warehouses. We're talking about hotels. We're talking about stores and shopping centers, and we're talking about garages, service stations. Essentially project types that are essentially privately funded.
Okay.
We saw a pretty big increase for commercial building back in 2016 with a dollar increase of 21%.
Right.
And it's more or less maintained that level in 2017. For 2018, based on still favorable market fundamentals, meaning what's happening with vacancy rates or what's happening with rents, we're looking for modest increases for office buildings and also warehouses. However, hotels does seem to have tailed off a bit, having reached a peak in 2016, and store construction has essentially sat out this recovery. So basically, the modest increase expected in 2018 will really be due to slight increases, further increases for office buildings and warehouses.
Let me ask you, Robert, as you're putting this report together, all the different factors that you put in here, how much of a factor is, things that are in the news right now, like tax plans and the stock market, things like that? How much of a factor is that?
Well, we do try to take into account political developments. Now, when these forecasts were assembled, it was in the month of October, and we were still waiting for the details on tax reform. And, of course, we've yet to see any details in terms of a infrastructure program. Now, more recently, something that has given some concern is that the House version of tax reform does remove the tax-exempt status of what are called private activity bonds, and that might have some negative impact on the institutional building segment and also public works. But, before we kind of go any further, I think kind of the key for our forecast is this. It is what is happening within the institutional building segment. And there's several important points that need to be brought forth there. This year has seen a surge in airport terminal construction. We've seen large projects start at, certainly LaGuardia Airport in New York City, a large project in Orlando, and large projects to LAX in Los Angeles, and also San Francisco International. And so right now, notwithstanding the fact that we haven't had a infrastructure program that would have some benefit for airport work, that is already taking place. Now, another positive thing that has developed in 2017 is that college and university construction has picked up after essentially pausing in 2015 and 16. And the reason for that is that the endowment returns have shown growth on the order of 10 to 15% this year after being essentially flat in the prior years. And what we found out in terms of construction starts is that college endowment investment returns will have a positive impact on levels of college and university construction. We've already seen that take place. And I think the key in terms of this forecast for non-residential building and as it pertains to your listeners, is that the institutional building sector of non-residential building, and there I'm talking about schools, I'm talking about colleges, I'm talking about airport terminals, I'm talking about sports arena projects, are still on an upward track, notwithstanding the leveling off that we're seeing for commercial building. So basically, if one is looking at the areas of growth going forward within non-resident, you really have to key on the institutional building sector for 2018. Now, for 2017, the estimate is for a 14% increase, and we have a 3% gain estimated for 2018. And although you might say 3% is not that much, I think this important point is that we are maintaining the enhanced level that was achieved this year.
That's right. And it's also probably important for me to point out to our listeners that you're talking starts here. And as I was listening to you talk about these airports that you're counting in last year, they still haven't put those floors in yet. So a lot of our listeners are really going to get a lag based on, your forecast and when they ultimately put floors in.
That's true. I mean, basically, if you kind of take that lag into account, that 14% increase that is our estimate for 2017 means a good level of growth for the institutional building sector as it relates to flooring in 2018.
Yeah, that's right. One thing real quick before we run out of time, just one last question. I'm seeing here where you've got an anticipated activity with the feds. You're actually calling for what you think is going to happen throughout 18. Talk about that if you would.
In terms of?
Yeah, feds and the interest rates.
Oh, the Federal Reserve.
Yeah,
I mean, we are looking at for moderate increases in the federal funds rate, but historically we're looking at what are still very, very low levels. Essentially the federal funds rate is currently in the range of 1 to 1.25%, and with 3 rate hikes that are expected in 2018, it gets up to essentially around 2%. Still by historical standards, this is a very low level. Of course, what affects construction would be long-term interest rates.
Right.
And notwithstanding some of the pickup in the short-term rates that we've seen this year, at least in terms of the federal funds rate, long-term interest rates really have remained quite low. They're beginning to edge upward right now, but I don't think the increase in 2018 is going to be that significant. I would be more concerned about interest rates, though, by the time we get to 2019.
Well, and for anybody that wants to see this report, it is available. What is your website where you can get this report?
The place to start off would be www.construction.com, and you'll be able to find your way to the report at that website.
Okay, Bob, I appreciate you giving us an update on this report. Again, been talking to Robert Murray, the chief economist with Dodge Data and Analytics, about the 2018 Dodge Construction Outlook, and you've been listening to Kemp Harr and FloorDaily.net.